Hi guys. So at MTM, we're not exactly pattern-driven traders. We focus more on structure, participation, and market phases rather than memorizing formations. But in the interest of expanding our perspectives and understanding how different traders approach the market, I thought we could look at one classical pattern today, the head and shoulders pattern, and see how it actually ties in with what we already study here at MTM. So first, with the head and shoulder pattern, context matters. It is intrinsically a bearish pattern, but where it sits decides whether it is a reversal or a continuation pattern. A head and shoulders in an uptrend is a bearish reversal pattern. So price makes a high, giving us our left shoulder. Then we make a higher high, giving us our head. And then price makes a lower high. That is, it fails to make a new high, giving us our right shoulder. That failure to make a new high is essentially your failure swing reversal pattern. And this is why this pattern aligns beautifully with what we learn at MTM. So today, we're going to focus on head and shoulders as a reversal pattern. So for that, first you want to see a clean prior uptrend. Have a look at my chart. Then, as already mentioned, a high. Then we want a higher high and then a lower high, giving us our three peaks. You can now see that the head must always be the highest peak in this pattern. But the pattern isn't confirmed unless we break the neckline. The neckline is simply a trend line connecting the two lows between the three peaks. And if after the break of neckline, price reverses and reclaims the area above the neckline, then we call this a failed pattern, which can often lead to strong moves in the opposite direction. Ideally, volume contracts as we move towards the right shoulder and then should expand on the breakout. That supports the idea that supply is stepping in. But remember, volume only strengthens the case. It doesn't define it. Now let's talk about the three ways to trade this pattern. So like I said, there are three ways to trade this pattern, but they all have different levels of risk. Let me bring up my little drawing, 1 second. So the first way to trade this pattern is an aggressive entry. Once the right shoulder forms, some traders draw a short-term trend line and enter on the break of that trend line with a stop loss either above the right shoulder or the head. The second entry is a confirmation entry where we can enter on the break of this neckline with a stop loss either above the neckline, the right shoulder or the head. And the third one is a conservative entry where we can enter at the retest of the neckline, again with the stop loss either above the neckline, the right shoulder or the head. Let's look at S32 as an example. So here we have a clean uptrend. Then price made a high, giving us our left shoulder. Then we had a higher high, giving us our head. And then we had a lower high, giving us our right shoulder. This pattern was confirmed at the break of neckline. Notice also how this pattern had a change of market structure within it. That's where the pattern meets participation. So the key takeaway is this: a head and shoulders isn't just a formation, it's a structural transition. If you understand the structure, the pattern makes sense. If you only see the shape, you're missing out on a deeper context. So I hope you guys found this as interesting as I did. Until next time, bye.